Hello everybody, Simon Dixon here. I'm about to get on the gym and I wanted to give a quick update as promised, as usual, as I have been doing for the last 3 days. Today we're going to be talking about my future forecast on DeFi, what it means for investors and the future of it. And we're going to be covering 3 rules that everyone needs to be aware of as we start forecasting what comes next in DeFi. 3 actions that I expect to see as a result. And then we're going to be going through 3 very quick cycles and 3 things that I expect to see adoption as a result. Okay, so when I think about DeFi, I think about a cat and mouse. And the cat and mouse is between the legacy financial system and regulators trying to take the decentralized financial system and make it more like the regulated financial system. So decentralized finance is the concept of once you give people through Bitcoin and other crypto assets the ability to own their own money, spend their own money, and have fixed supplies, you get a fixed supply that drives a lot of adoption in terms of people saving and having a wealth effect. This is not good for governments. Governments want to see what's known as the velocity of money. That means they want you to spend that money. And so the way that that is achieved with traditional currencies is by devaluing them, by increasing the supply of the currency, which then drives people to want to spend them because they know they're going to be worth less in the future. And because this rewards people that take on debt, it increases the money supply and increases what in economics we call velocity of money. Which is the speed at which it circulates. In crypto, it's a completely opposite way of thinking. It rewards the saver, so in Bitcoin, it rewards the saver historically over time, and therefore people don't want to spend it, so it decreases the velocity, but it leads to a wealth effect. And once you have a wealth effect, you tend to think about investing, and when you think about investing, you then start to recycle that more into investment activities. So fiat currency drives people to consumption. The crypto industry drives people to saving and investing. So that is what's happening in the industry. And therefore, as a result of that, now that people can transact peer-to-peer, you had the emergence of the decentralized financial products and smart contracts and all sorts of things, that we've had a wave of innovation. I think it was this time, maybe 2 years ago, that I was on stage in a Miami conference, and DeFi was about 250 million. It's now into several billion, tens of billions. I was telling them this is going to be a big trend, but it will lead to, after a couple of years of cat and mouse, to some of the things I'm going to discuss today, and then investors need to go through and be aware of those cycles. So the cat and mouse game is as follows. Regulators need by their laws and their mandates to give regulations to financial institutions to exercise more influence and control for the reasons that I'll cover in this video briefly. And therefore, technology comes along and says, well, if we can allow people to transact peer-to-peer, we can allow them to engage in peer-to-peer insurance products. So we can allow them to engage in peer-to-peer loans. We can allow them to engage in collateralization and various other what we call decentralized financial products. They call them decentralized because you own the private key, which means that you own ownership, like a bearer asset, they called it back in the day. And by proving that, you can then engage with a technology that allows you to enter into a peer-to-peer agreement that is enforced by technology and code. So rather being enforced by law, it's enforced by technology and code, but regulators want to put law on top. So regulators have to enforce laws. Laws are set by governments, and therefore regulators put together rules in order to go through this cycle. You get a cat and mouse cycle where new regulations come in order to combat. New technology is invented, the regulations become outdated to the new technology, and then you have this constant fight between technological development, which is very, very ultra fast. The cycle of development in the crypto industry is rapid, unlike anything I've ever experienced, and it's going exponential in terms of its growth. Regulations are very, very slow, clunky, take years to implement, lots of bureaucracy in that process. And so therefore you have lots of bureaucracy trying to catch up with rapid technology, and then once the regulations catch up with the rapid, you get implementation and then a complete reinvention of the technology. And so that's what we're going to see over time. So what are some of the things that are happening right now? Well, you've got 3 rules that I believe are going to be very impactful upon any investor engaging in the decentralized financial technology. The first is something implemented by Financial Actions Task Force, let's call them FATF, and they are a global regulator that regulates the regulators. And so an agenda is passed, normally comes from the US, goes through to the Financial Action Task Force, and then is implemented and enforced globally upon all regulators that they have to adjust to. The first is this concept of controllers of influence. And so FATF want there to be a controls of influence in every DeFi project. So they're going to try and pin it on somebody. Most likely that will be the developer, or it could be the person engaging in the decentralized product. And so by taking out a centralized institution in the middle, they want to try and figure out how to put together a natural entity. So there's going to be lawsuits and all sorts of stuff around who is the controls of influence. Is it the person initiating the smart contract? Is it the person on the other side of the smart contract? Is it the developer? And they will probably enforce putting in centralized entities as controls of influence, and maybe enforce that by law. So that's the first one. So that's going to cause, more innovation like Bitcoin, where it's created by pseudonymous people, and really the debates and lawsuits that come as a result of that. So it makes development more dangerous, essentially, and engaging in DeFi more dangerous, so that they can try and curveball adoption to implement the rules so that the regulators can catch up with the innovation, is the first one. The second one is securities laws. So what typically happens with these decentralized financial products is they launch a token in order to allow people to use that token for the governance and voting and determining the future of the direction in absence of a control of influence, as FATF calls it. So what does that do? Well, that means that you have people that need to be implemented as a control of influence. The governance token comes along and tries to add some governance layers to that, but many people come along, try and invest in it, and then they start to define it as a security. And securities means that they have to be restricted to certain types of investors. They can only be used once the token goes through an onboarding process to apply and then meet all sorts of regulatory requirements. And so the governance token doesn't really work as a security. It means that it can no longer list on a cryptocurrency exchange, and instead can only be listed on a securities token exchange. The third rule to be aware of is travel rules. This particularly affects DeFi contracts and stable coins as well. So stable coins, if you're not familiar, is a way of putting fiat value, stable short-term value. Definitely don't confuse it with long-term value, because they're very unstable long-term. Fiat currencies tend to be depreciated. But short-term, they are stable value. So people put them on a blockchain so that you can send fiat value around the world a lot closer, and it's an essential part of the decentralized financial ecosystem. I'd expect stable coins, depending on their backing. So this drives more people to algorithmic stable coins, because if they're backed by assets, then one could argue, and lawyers will argue, that it's a collective investment scheme, which then makes it a security. And making a stable coin a security completely defeats the purpose of what it was originally intended to do, to speed up the flow of funds in fiat value. So you'd have that. Now the third rule that I'd expect to see is travel rules. Travel rules is the next one to come, which is where it requires participants. So if you're in a peer-to-peer transaction, or you go through what they like to call a virtual asset service provider, which is the controls of influence, then they have to, the recipient and the person sending the funds need to know lots of details about who's engaging in that transaction, whether it came from another virtual asset service provider, whether it's a peer-to-peer transaction, and certain personal information centered around that. So those are the three rules. You've got securities laws, you've got travel rules, and you've got controls of influence implemented by Financial Action Task Force and other regulators. That will lead, the actions that I expect to see next is that you will need, there are three things coming to DeFi. The first is on-chain know your customer regulations. So when you're engaging in a smart contract, you'd have to provide the details. That details would be embedded into the contract, and therefore it can meet the other two rules, securities laws, which is restrictions. And so that would lead to the second action, which is on-chain whitelisting. So securities tokens, they have to go through an approval process, on-chain KYC, and on-chain securities law compliance if it relates to securities, and then it can be whitelisted. Only whitelisted addresses can engage in a DeFi contract, and then that leads to more data being put in so that it can comply with travel rules. So I'd expect to see three actions as a result: on-chain KYC, on-chain whitelisting, and more data being put through in these travel rules. Now, what will that do? The reason the cycle this goes through is three cycles. It always begins with the justification that is easy to justify the most, which is anti-money laundering. And so telling people that this is all implemented in order to protect you, to prevent crime, and to eliminate crime is an easier sell than the reality of what it is. The first cycle that you tend to see is fear-led adoption of rules and regulations through anti-money laundering regulations that then leads into the real agenda, which is tax collection. So once the data is all known, then you get the tax information so that governments around the world can ensure that they're collecting their piece. And then finally, this leads to anti-competitive behavior, where you tend in the traditional cycle, rules around anti-money laundering, leading to those, the number one definition being tax evasion. And so then that leads to new tax rules. And then that goes through the cycle of these information being used to drive anti-competitive behavior. So, sorry if I piled a lot on there. Sorry if it's lots of regulations. You know, having run a regulated institution, banktothefuture.com, we tend to see many of these cycles from many of our portfolio companies, having invested in over 100 different companies, whether it be exchanges and all of the many different virtual asset service providers, just sharing the typical cycles and forecasts on that. So what does it mean to you as an investor? So as an investor, I'd expect this to be at some stage a big speed up in DeFi, a big slowdown in DeFi, a big speed up in the next wave of innovation, a big slowdown in the next wave of innovation. Over the last 10 years since I spoke at the first Bitcoin conference, I've seen these cycles several times. I've seen, you know, we had originally back in the early days in 2011, we were trying to put Bitcoin colored coins into stock exchanges. We had, you know, virtual IPOs. We had Bitcoin denominated securities. Regulatory crackdown. Everyone realized, okay, owning your own money doesn't mean that you're exempt from these laws. Then the next cycle you saw was initial coin offerings, where people were saying, well, you don't need to comply with securities laws if you make it a sell of a token. But then that went through a regulatory crackdown. More recently, you had DeFi, and then that led to the governance token, and then you go into the cycle that I've shared today. So, what is an investor meant to do? Well, this leads to my investment thesis. For those of you not familiar, approximately 1 year ago, I released on retirementplanb.com a 4 3-part video series where I shared exactly how I'm investing 1 year ago, $1 million of my personal savings, and how I do it if I had no savings. And tonight, we're going to be giving and launching our live masterclass where I'm going to be going almost 10 hours of content, not in one session, over the next week. And I'm going to be giving live broadcasts. And I'm going to be giving an update on what all of that means. And I'll share with you a little bit on what it means in relation to this particular topic of DeFi. So if you haven't registered at retirementplanb.com, I'm going to be going live, I think it's 5 p.m. GMT tonight. Check that in your time zone. And we've been doing live masterclass 1 where I'll be sharing exactly how to know whether you should be buying or selling Bitcoin in the current markets, and then there'll be structuring masterclasses, understanding tax implications, not as a tax advisor, and understanding how to put together some of the asset protection structures and various other things. Anyway, I expect this to lead to adoption in 3 different areas. 1, this drives people to Bitcoin. So Bitcoin adoption, I believe, is set to increase as a result of all of these trends because it truly has followed the rules of having no controls of influence. I also expect to see a greater adoption in Ethereum, which has reached a certain level, and obviously many of the risks in its migration to ETH 2.0, but I'd expect to see all of that on-chain KYC, on-chain whitelisting, smart contract development, innovation, cat and mouse games, until you get this end result and standard. I expect that to happen upon Ethereum, and therefore the easiest way is through Ethereum adoption. And I expect to see a massive wave of innovation and decentralization as a result of everything. So rather than the fake decentralized products, I think we'll start to move the needle more and more, and that drives adoption to the longest chains, Bitcoin and Ethereum. So I think that much of the decentralization happens there, because if you're launching new chains, trying to get adoption, then they tend to need a person to drive them, and that becomes a control of influence, and therefore some of the things and the cycles that we talked about today. So if you want to understand how to put all that together, then join me at retirementplanb.com, register over there, and we're going to be going live in the live masterclass to share exactly what happened over the last year, what's changed, what to look for the next year, and always remember, even when these regulations seem very down and depressing, there's always a cycle of investment. You can't let the cat out of the bag. This cat has been let out of the bag, and you can't put it back in. And therefore, you as an investor can look at the very simple things that one can do to get on the right side of these changes. So always remember, you are alive at one of the most interesting and exciting times in financial history. There's going to be a lot of change. Some people are going to be on the wrong side of that change. Some people are going to be on the right side of that change. And I want you to be on the right side of that change. I'm going to get my ass on the treadmill, start my workout, and I'll see everybody at retirementplanb.com for the live free 4-part masterclass tonight. Peace.